Welcome everyone to the first session of the 2021 Indiana Leeds Summer Tax Workshop Series. I'm Leandra Lederman, the William W. Oliver Professor of Law at Indiana University, Maurer School of Law, and it's really terrific to have everyone here for the first session of the second year of this series. So with that, let me turn it over to my co-host, Leopoldo Parada, who's going to introduce himself and today's speaker.
Thank you very much, Leandra, and let me echo your words as well, and welcome everyone. And thank you for joining us in this new season, the 2021 Indiana Leeds Summer Tax Workshop Series. For today, we have a fantastic speaker and also a very good paper. Today, we have Professor Mindy Herzfeld from University of Florida. Professor Herzfeld is a professor of tax law at the University of Florida. And prior to joining Florida, since 2014, Professor Herzfeld has been a contributing editor for Tax Analysts, authoring weekly columns on international tax policy development and cross-border transactions in Tax Note International. She continues to serve as a regular contributor to Tax Notes International and is also a counsel at Ivins, Phillips & Baker, a specialty tax law firm based in Washington, D.C. Prior to assuming the position as tax analyst, Professor Herzfeld worked as an international tax advisor for Deloitte Tax LLP, based in its Washington, D.C. and New York offices. She began her career at Weil, Gotshal and Manges in New York City, and has also worked as a tax counsel at Ford Motor Company. Professor Herzfeld received her JD from Yale Law School and her LLM in taxation from Georgetown University Law Center. She has published over 100 articles in Tax Notes International and Tax Notes, many of which have been cited in law review articles by leading international tax scholars in congressional research service reports, especially the party studies. So let me stop here, and thanks, Professor Mindy Herzfeld, for joining us. And now, Mindy, the floor is entirely yours.
Thank you so much, Leopoldo. I'm sorry I interrupted you before. I just wanted to correct that number. It's over 200 articles in Tax Notes. It's really my honor to be here today. I think Leopoldo and Leandra, you ran such a great symposium over the summer last year, and I really enjoyed it. And so it's an honor to be kicking it off this summer. And I want to thank everyone in advance for indulging my paper, which is in a very preliminary stage. And so sorry for imposing on everyone to read what's very clunky in some places. This is a crazily ambitious paper. And so I am hoping to get comments, lots of comments as to how to make it a little more manageable. It's crazily ambitious, I think, because it's really interdisciplinary and not just not just two disciplines, but really crosses over from law to accounting, and not just tax law, but also constitutional law, which is not my area of expertise at all, and also economics, of course, and also trade law. And so let me, I thought that before I go through the slides I prepared, I thought it would be helpful to explain how I ended up in trying to write something that covers many areas that are not my expertise or background. So I started off wanting to write something or thinking about the U.S. foreign tax credit, which is actually something I know something about. And that, of course, had to do with the different types of digital services taxes that are being enacted by lots of different countries all over the world. And those get attention. The U.S. reaction to that gets a lot of attention, primarily these days because of discussion over whether the U.S. views them as discriminatory, and so how the U.S. might respond to them from a trade perspective. But what doesn't get talked about as much is whether these types of taxes might be considered creditable taxes under US tax law. And so that's obviously a very important question from the perspective of the taxpayers who have to pay this tax, and also the US Treasury, that if these are creditable taxes, the Treasury would end up bearing the cost of them. And so that led me to think more about the origins of the U.S., how the U.S. defines a creditable tax, and that goes back to the U.S. only credits taxes that are called income taxes, and what an income tax is developed. The law on that is developed in a series of older cases, but then more recently, when I say more recently, going back 20 years, in regulations that define an income tax as a tax that encompasses some concepts, gross revenues, gross receipts, a realization event, and to be imposed on net income. Okay, so that's fine. But what happened last year, the Treasury and the IRS put out regulations that said, oh, well, we're going to add another requirement to these regulations. We're going to say that decades-old definition is not sufficient. In order to be a creditable tax, you don't only have to meet those requirements, you also have to impose tax restricted to concepts of jurisdictional nexus that are the same basically as US concepts, which it says are consistent with international principles, whatever those may be. That's my gloss, that regs don't say that. So you've got this long-standing definition of what a foreign tax, what a creditable foreign tax is. It's got to be an income tax, and then you've got the Treasury, then you've got other countries kind of testing that principle, and you've got the U.S. Treasury saying, well, in addition to all those requirements, we've got a jurisdictional requirement. So I was thinking about all that, and then I was thinking about writing a paper, kind of why do we require creditable taxes to be income taxes to begin with? And then Ariel Kleinman and Jordan Barry, I don't know if they're on, if they happen to be on, wrote an excellent paper on the topic. And I said, well, that went my thinking on in this area. But actually, what I had been thinking about, which wasn't covered in their paper, was the question, the interaction between when the U.S. tax law defines what a creditable income tax, what a creditable tax is, and the accounting treatment of taxes. And so the accounting rules have different standards for how an expense, a tax expense, is recorded, is treated, and disclosed, how much disclosure is required, depending on whether the tax is an income tax. And so I started thinking about different definitions of income tax for the foreign tax credit purposes and accounting rules. And I was concerned about a possible disconnect being aggravated if the US tax law goes in one direction in terms of how it wants to define an income tax, while the accounting rules go a different place, because the accounting rule that while an income tax is on a separate line item for accounting purposes, non-income taxes are just kind of shoved in to cost to the general gross receipts, costs of goods sold line. And there's a whole debate going on now about more disclosure of income taxes. And so how would that all fall out if that whole debate is only about income taxes, and then you've got lots of new categories of taxes being paid by companies that are not income taxes, and so for accounting purposes, and so would fall into this other category and not be caught up by disclosures. What other kinds of incentives are you putting on companies, or pressures are you putting on the financial reporting system for how to decide whether something's an income tax or not, and what kind of odd results will you get when you've got a divergence of both treatment from an accounting and a tax law, U.S. tax law perspective on what's an income versus a non-income tax, and how are those differences magnified the more pressure you put on what companies have to disclose from an accounting perspective for income taxes. Okay, so that was one whole area, but related to that, I had been thinking for a while about, and for anyone who was following the debate in the US over the destination-based cash flow tax, which was proposed in 2016 before the major US tax reform was passed in 2017, that tax was a tax, that proposal was introduced as a way of getting around or addressing what the political leaders who proposed it said was an unfair treatment of income taxes versus non-income taxes in the trade agreements. And so in trade agreements, indirect taxes, like the VAT, are considered, you can have a border adjustment for an indirect tax like a VAT, so you can provide a rebate for exports, but that's prohibited under trade agreements for income taxes. And so I was caught between, so I got stuck on this binary distinction also in the trade world between, or in trade agreements, excuse me, between income and between direct and indirect taxes, and trying to figure out whether that distinction between direct and indirect taxes has any more meaning. And the income versus non-income tax distinctions between in the tax law and accounting law. And if you dig back into the history of the trade agreements, it's not entirely clear whether the distinction between direct and indirect tax, as they made their way into the trade agreements, is really based on economic theory or economic policy, or whether it has more to do with the political negotiations at that time. EU countries had a VAT, although it wasn't as prominent as it is now, and the US didn't, and various political negotiations apparently made the US dismissive of whether this was an important distinction that was being put into the trade agreements, or the people negotiating the trade agreements were less concerned about this, or whether there was some kind of informal understanding that the EU wouldn't challenge the US rules that could be considered export subsidies, despite this language being introduced into the trade agreements. But of course, that's not what happened, and US export subsidies, various iterations of them, have been challenged regularly and held several times that violated the WTO agreements, and so the US has continuously updated or reenacted or revised its laws to try and figure out how to provide some kind of export subsidy that's not an export subsidy under its income tax laws that could match or provide a balance to what it thought was the benefits that the EU countries were getting from the fact that the VAT could be border adjusted. That debate, of course, remains unresolved, but it was brought, it was kind of heightened by this destination-based cash flow tax proposal, which raised many of the same issues. And the point of the politicians and some economists was that, well, this really has the same results as a VAT, and so it shouldn't be an export. It shouldn't be considered to violate trade agreements. And then, of course, the US passed its foreign-derived intangible income deduction, and so questions have been raised about whether that is also a violation of trade agreements. And so, aside from the fact that there's a question about whether there's the distinction in the trade agreements is based on economic theory, there's also, I think, new economics research coming out about how that distinction really holds in the real world, given kind of the way that operates both in terms of its how many exemptions are built into the system, and also how enforcement. And so you've got two questions there: one about the rationale when it went in, and then two, how even if there's a formal distinction, how much sense that makes. And then, because I was talking about direct versus indirect taxes, I couldn't really ignore the Constitution, and because last year there and still now there's lots of debate about a wealth tax, including questions about the constitutionality of a wealth tax, because the Constitution draws a distinction between direct taxes and indirect taxes in terms of how they can be levied. And so, whether or not you call something a direct tax or not a direct tax is of high importance from that perspective. So, even though I think the odds of a wealth tax being enacted are very slim, I had to go back to the understanding how the term direct tax made it into the Constitution, and there. Whatever it meant a couple of hundred years ago, it's clear that our thinking, economic theory, has moved on from that time. And so what direct tax meant to the authors of the Constitution is certainly not what the people who drafted the trade agreements, GATT and GATT and the related agreements, thought was meant by the term direct tax. And so that led me to this grand paper on how do we make sense of these binary distinctions in defining taxes as income or non-income taxes, or as direct or indirect taxes, and how do we address the challenges that having this kind of binary distinction causes us to, as we wrestle with what are really ongoing questions in the trade area, in the foreign tax credit area, in the accounting area, and possibly in the constitutional law area, and what's the right answer for how to make sense of this when if the binary distinction doesn't make sense. Is there a more principled way to approach this, or is it just too complicated? So that's the history of my paper, and I don't really have a conclusion right now. So I welcome any and all thoughts as to how to where this might lead, and where I could take it, or how I could trim it down to make it more manageable. And I apologize in advance for all of you who may be experts in the field other than my own field of expertise if I garbled your the subject matter on which you know more about than I do. And I really look forward to comments, so thank you.